This is Capital Ideas TV. Coming up, the CEO of AcuityAds, Tal Hayek, leading the way in the booming sector of programmatic advertising. Fabrice Taylor on how to profit from bot deals and secondary offerings. And the CEO of Symbility Solutions, strong growth through artificial intelligence. Tal Hayek was one of the founders of AcuityAds in 2009. 8 years later, under his leadership, the company has a market value of nearly $125 million and is one of the leaders in the fast-growing sector of programmatic advertising. AcuityAds grew its revenue in the second quarter by 146%, and profit margins sit at around 50%. Hayek is engineering this growth organically and through acquisitions. Hello and welcome to Capital Ideas TV. I'm Mark Bunting. Now, a few months ago, we interviewed Tal Hayek, the CEO of AcuityAds, and the title of the story was WTF is Programmatic Advertising. Let's start right there. Here's our conversation with Tal Hayek. Tal, we talked a few months ago when we did a cover story on AcuityAds in Capital Ideas Digest, and we used a rather cheeky headline, which was the WTF Programmatic Advertising. You know your business, but not everybody does. So let me ask you, WTF, programmatic advertising, what is it and what do you do?
Well, programmatic advertising is the process of buying and selling ad units in a programmatic way, which is an auction-based system bought and sold in real time. I'll give you an example. If you're a consumer, you're on your phone, you go to CNN.com, you see the content of that page load, and you see the ad load, and it looks like it's loading at the same time, but it doesn't. What's really happening is the content loads first, and then CNN sends a bid request to an ad exchange asking for two things, a creative and a price to pay. It goes into our system. We have a machine learning system that would make a decision in 50 milliseconds about how much to pay for that ad, decide on the type of ad that's going to show. And that's based on information we know about you personally. So demographic information, geographical location, what are you interested in? Then we pick the right advertiser, let's say BMW, for example. We send it back to the ad exchange and say $5. For the highest bidder, we get to show you the ad. And the whole process takes 50 milliseconds. So That's what's going on in the background every time you go into a website or an app out there.
So that explains if I'm looking for a vacation, I'm suddenly getting all these ads for vacations and destinations.
Yeah, and the idea is if you book a flight, we want to send you deals for hotels and things like that to just to increase the chances that this is something that is relevant to you, that you're interested in.
And you have patented algorithms and machine learning techniques to make all of this happen?
Yeah, it's all about AI, and we work very, very hard. One of our founders of the company is Dr. Nathan McCuse with a PhD in machine learning. And we have a number of patents out there, but mostly it's a proprietary way of doing this.
Give us a sense, Tal, how the advertising market has changed over the past few years and the shift into programmatic and how big the market is.
So years ago, traditional digital was more seen as the type of advertising that TV and radio was. The message was one to many. So both of us will go to Yahoo Sports section, we would see the same ads. Today, when programmatic is around, we're going to go to Yahoo Sports section, we're going to see different ads. That's what programmatic is all about. It's about sending the right message based on the information we have and the data we have about the consumers. So the message is moving from that one-to-many, like in the old days, to the one-to-one conversation.
So you're a leader in this field, but there's competition, the Trade Decks of the world, Media Math, Rocket Fuel, and so on. How do you differentiate from those kinds of companies, and is there room for everybody?
I don't know if there's room for everybody, but I think there's room for a few winners out there. The big differentiator is the algorithm. At the end of the day, what advertisers are looking for is positive ROI, and if your algorithm is good and delivers that positive ROI for them, you're adding a lot of value. You're really making the money, and they want to use you more and more and more. And the biggest proof point with us is our customers are happy with what they're seeing with us, and they're spending more with us over the years. And the size of the industry, advertising in general, is over $500 billion. Digital is about 80 something billion, and programmatic is about 50, and it's growing at a rate of over 20, I think around 27%, programmatic itself. And then the next big phase is TV is about to change. TV is about to turn completely digital, and in the next few years, I believe we'll be able to send personalized ads to TVs, to more traditional TVs, which opens up the whole advertising market to programmatic.
And you're angling in that direction as well?
We are not banking on it, but this is something that we're doing a lot of work on. Obviously, we bought a video company not too long ago, part of our strategy to become closer to the TV world, and we strongly believe that it's going to change, and we're doing a lot of work on that area.
And that brings us to your acquisition strategy. You said you'd like to do 1 to 2 a year. You've been doing that. One analyst said recently you're probably sharpening your pencils right now. Do you have any in the burner right now?
Well, we're working. We're always in the market, so we're always spending a lot of time in the market and talking to many companies, and there's a lot of companies that we can buy. We're very selective, and we're going to buy the right companies that's going to add the most amount of value to our shareholders. So this is where we're going. Yes, we would like to acquire something soon, but there's nothing concrete right now.
As far as your customer base, you have some big names which you shouldn't be shy about. Give us some of the customer names that you have.
Well, generally speaking, we have a lot of the Fortune 500 companies, international brands, a lot of the banks, auto companies that are working with us. In the States, some of the companies we acquire are working also with the really big brands. So generally speaking, that's the type of companies that are running on our system.
Let's get to some financial metrics, Tal. You founded the company along with some partners around 2009. Tell us about the growth since then, and then the most recent quarter, revenue up 146%.
Mm-hmm. So started 2009, the first 2 years we were just building the technology. 2011 we commercialized. Did about $1 million in revenue then the next year was $5 million, then $10 million. Then we did 21 million, and then last year was 39 million. So all in all, it was a great journey so far. Last quarter was again another great growth quarter, and we expect to keep doing that.
So this kind of growth is sustainable, you think?
From 2 ways. The organic side is growing substantially, and we're going to keep acquiring. So yes.
And then insider ownership in the company. Last I heard it was around 50%. The founders have a big chunk. Is that about right?
I think it's about 42. Founders management is about 42% of the company. And yeah, that's about right. So that means we're really, really motivated to make this a great success story.
And is that the message you think it sends to shareholders, that you guys really have skin in the game?
I think so. That's what we're getting mixed messages. Some people are saying it's great that you have such big skin in the game, and other people are saying, well, you shouldn't really be more than 20% because the float is too small. So, I mean, as we go and we do more raises, that part goes down. So it fixes itself.
And lastly, Tal, take us out 2 to 3 years. What does your company look like at that point?
Well, I think we're going to make some more acquisitions. We're going to strategically acquire more types of businesses that are great to be under one platform. And whenever we make an acquisition, it needs to be strategic, but also it needs to be financially sound. So that's very important. So I believe we're going to keep on growing aggressively and have a more complete platform for advertisers to use.
We are keeping track of insider activity for you to see which officers and directors are buying and selling shares in the companies in which they're involved. We'll take a look here at PHX Energy Services. The stock has been weak lately, but the CEO and president of the company have been using this weakness as buying opportunities. The CEO specifically now owns nearly 12% of PHX Energy Services, and the president has increased his stake by 50%. Fabrice Taylor likes to pull back the curtain on what can be a sometimes confusing stock market. This week, he examines bought deals and secondary offerings and gives you some advice on how to profit. Here's our talk with Fabrice Taylor. Fabrice, investors are often presented with various terms which they may or may not be that familiar with. We're going to focus on bought deals and secondary offerings. Let's start with bought deals.
Sure. Well, a bought deal is when a bank, an investment bank, or a group of banks offer to finance a company or sell its stock in a way where they buy it, they guarantee the price basically. So they'll get together, they'll buy that stock from the company or whoever's selling it at a certain price, mark it up a little bit, and then sell it to their clients. It's great for the company because it has certainty. It doesn't have to go out there and hope it can raise the money it needs or sell the stock it wants to sell. It's a risk for the banks because they are committing to buy that stock. And if they can't sell it at the price that they paid or higher, they're going to lose money on the deal. And what I've noticed lately is a lot of the bought deals that are coming from the street are getting hung. What that means is that the price goes below the bought deal price and the banks end up holding the bag and losing money.
Why is that happening, do you think?
I think a part of it is just the summertime, but I think that there's a lot of fear in the market right now, and people are not particularly optimistic. They're skeptical, and I think just the record of recent bought deals is such that they're all failing. But the good news is that you can actually make money on this phenomenon. There's a nice trade to be had. Typically, when a company, when the deal is hung, the bought deal gets hung, the stock will drop, and then they'll do what's called the cleanup trade. So the banks will get together and say, okay, we're losing money, we've got to move this inventory off our books as soon as possible. So they try and figure out where can we do the next, or they'll lower the price, and then they'll offer it to their clients again. And it's at a sharply lower discount to what they originally priced it at. So if you're quick enough, even if you're not going to be invited into the cleanup trade, because that you have to have an account with the banks, but if you're quick enough, you can snatch up these shares and oftentimes make a pretty decent quick return. It's relatively safe because the stock has been higher very recently, so typically it's going to go back to the level that it recently traded at.
You're talking about more so sophisticated investors as opposed to a retail investor who may not have access to that, or well, could a retail investor embark on that strategy? Anybody
can. Obviously, to get access to the bought deal or the cleanup trade, you have to have an account with those firms. And even if you do, you're not necessarily going to get your full fill. For example, I recently took part in a Dream Global REIT bought deal at $10.50. The stock had been about $11.05. They made an acquisition. They needed to raise $300 million. That's a lot of money. And they did it via bought deal at $10.50. So what typically happens is the broker will call you that night, the bought deal, it's live, how much do you want? I put my order in, next day I'm underwater because the stock went down to $10.30. So the deal was hung. I still had to buy it at $10.50. And then they did the cleanup trade at $10.25. So I loaded up on it. I know the story. I already own some. It pays a dividend. It's relatively low risk. And the stock 2 weeks later is over 11 again. So, I've sold a little bit of it because I bought more than I needed. But nonetheless, it was a very quick 6-7% return for me in about 2 weeks. So anybody can do it. I had to have access to the deals. But if you don't, you can buy it in the market because it did trade at 10.25. The cleanup trade was done at 10.25. So if you'd bought it at 10.27, let's say, you made a quick 70 cents per share. So it's not a bad little return for a REIT.
Another example is a Norbord.
Yeah, so Norbord did a secondary. You mentioned that earlier, so let's explain what that means. A secondary is not a treasury issuance. It means a major shareholder wants to exit his position in full or in part. In this case, it's a pension fund that was a big shareholder. And so again, they hire a group of investment banks to do a bought deal. This one was announced, I think it was $42.85. The stock went below that price, deal was hung. They did the cleanup trade again, and then the stock went right back to where it had been trading at before. In fact, maybe even a little higher than that. And I think you'll see it continue to move higher in the next couple of weeks. The nice thing about these trades is that typically bought deals are done when a stock is moving higher anyway, so it has momentum. So you're getting that discount and then the second discount, and then once it's all cleaned up, you get that tailwind that moves the stock higher. So I like to buy a lot of these things, but I'll trade them for a quick 5-6% gain.
Interesting. And then another example you have is Northview.
Yeah, this is just very, very recent. Yesterday I got a call from my broker. This time I learned my lesson. I said, I'm not taking it. I'll wait for the cleanup trade. And sure enough, it's trading below the bought deal offering price. So I'm guessing the cleanup will come in the next week or two, and I'll be a buyer at that point.
We'll start with Zoe Medical Pharmaceuticals, a big breakout here. In fact, a double on the shares from around the 150 level. The stock breaking out meaningfully there to 52-week highs. The company announcing that they're going to seek a listing on a major U.S. exchange. We'll also have a look here at Toromont Industries, which recently bought Hewitt Group for nearly $1 billion. It's a Caterpillar dealership chain, and you're looking at Toromont breaking out there. The market's really liking it. 52-week high on that one. Now, on to some 52-week lows. Not surprisingly, we are still seeing energy shares plumbing lows that they haven't seen for a long time, including Storm Resources on the venture, breaking out to lower levels there. And then we're looking at Parex Resources. Mea culpa, about a year ago, this was an idea in Capital Ideas Research Digest. The stock, though, sorry about this one, had a decent run, but it has been hitting a 52-week low lately. Symbility Solutions is helping the insurance sector come into the digital age. It's doing that by using artificial intelligence to make the claims process much more efficient. And at the same time, the company is exhibiting very steady growth. Here's our conversation with the CEO, James Swayze. So James, the term artificial intelligence is very hot right now, but it's probably intimidating for some people who don't know what it is or how it works. So how does AI apply to Symbility?
Well, the way we're going to be using artificial intelligence is by taking all of the data that we've accumulated over the years, and we've been at this for a dozen years now, have accumulated millions of property insurance claims, and that includes every nut, bolt, and screw that went into fixing your flooded basement. We have over 100 million photographs of damaged properties. And the sophistication around these algorithms associated with artificial intelligence is constantly improving, such that image recognition for photographs, for example, or the ability to learn from a replication of processes that you can then do with as little human interaction as possible. So in theory, if I've done 1,000 flooded basements, I should be able to settle and determine within a real strong degree of accuracy what yours is going to cost by virtue of asking you 5 questions and taking 3 photographs.
So your company breaks down into 3 segments: property, health, and strategic. So how are they different and how are they the same?
The property division is our primary platform. It's a platform that includes a cloud-based communication hub that involves all of the constituents that would be involved in getting you back to whole as a loss from that flooded basement. Our health platform is for employee benefits. Similar concept, cloud-based communication hub that's connecting all of the different pieces that is your employee benefit package. And then our services division, we call Symbility Intersect, is focused on providing these types of application development services to our customers. I think the insurance industry, who largely is our core primary customer base, they're still pushing their way toward creating tools that allow them to better interact with their policyholders, and that's what we want to lend a hand on.
So a lot of companies are in the AI sector, a lot of them are pushing into it, even in your sector, of course. So how do you differentiate from your competition?
Well, we're not trying to differentiate by virtue of building out these models today. We're working with companies that are already in the business. And here in Toronto, there's a wealth of new companies that have been trained at the heels of the experts at the University of Toronto within the Vector Institute and so forth, and working with those companies that have built those models while concurrently bringing in our own resources that we can ultimately pull that back in-house. We're taking a more gradual approach, but leveraging the companies that have already done it. The differentiation for us is the fact that we have the data. Again, about 1 billion pieces of data, having accumulated claims in 8 countries around the world with 60,000 users, pushing millions of claims through the process, all having been on a cloud-based environment, so all running over our servers, and our license to that data allows us to learn from it to better the products.
Would you say that pretty well all of your customers are very accepting about what you're doing, or are some a little resistant, and they're still maybe a bit old-fashioned?
No, I think they're all old-fashioned, no question about it. But they're all as curious as the next, trying to find a way to make their businesses more efficient. And if they think we can find the answer through the data that we've accumulated, and not just specifically the data from their company, but an amalgam of 8 different countries can yield a lot of different information.
Let's talk financials. James, what kind of revenue growth are we looking at? Are you looking at profitability Q4 of this year? I saw that in one analyst report.
We gave guidance on this year to do between 40 and 42 million of revenue, which is roughly 20% growth. That's been our growth path for the last few years, with an adjusted EBITDA of 2 to 3 million.
And your profit margins are steadily around the high 60s, 70%. How do you do that, and is it sustainable?
It is sustainable, and we're trying to constantly improve that. Your services business is a lower margin business, but it's a great service to offer to our customers to help them to build confidence in our ability to build software if they needed changes to our platform. But the platform play is where you get the highest gross margin, upwards of 80 and into the 90s.
So in 2013, I guess it was, CoreLogic out of the US took about a 28% stake in Symbility. And I saw some stories back then that said, well, they're probably going to take them out at some point. Here we are nearly 4 years later. So are they strictly a partner, or is there, I guess there's always a possibility of they may finally knock on your door and say, hey, we want to buy you. What do you think?
It's always a possibility, yeah. But they are a very strong partner of ours. Not only are they a 28% shareholder, they are our business partner in the United States, Canada. They provide the labor material prices. CoreLogic is a $4 billion market cap company out of Irvine, California that's focused entirely on property information. So they have information on every parcel of land in America, for example, every MLS listing, photograph, you name it. Being able to source the data from them into our models and into our applications is giving us a real advantage over other companies in these markets. Then in Australia and New Zealand, they have a very robust sales force. So they act as our sales and marketing team in those markets as well. So we have a very comprehensive relationship. They have seats on the board, a strong share ownership, and we're just working toward constantly improving the business and benefiting each other.
As far as investors are concerned, current shareholders, potential shareholders, what do you say to them? What's your message to them to convince them that the Symbility is a strong investment?
If you looked at all the technology companies in the market, there's a handful of the unicorns that are growing at 40, 50 and greater percentages. There's not that many beyond those who are growing at a steady 20% rate. So we have steady growth. We have a very sticky product. We have, as I said, 60,000 users around the world pushing claims over a very robust communication hub, one code base, fully ISO certified in 7 countries around the world right now. Once you've built and amassed that much, it's very hard for it to go sideways, is what I would say. So not only do we have the natural growth, but now that we're tapping into all of that data we've accumulated and the wealth of information that can be funneled into these models from an artificial intelligence, machine learning perspective, that opens up a whole new set of doors, because our goal is to take a set of tools that we built for experts, adjusters, insurance specialists, contractors, and put them in the hands of you and I, the policyholder, such that I can answer a few questions, take a couple of photos, maybe a video, and the outcomes are in my hands, the money's in my account. That's the nirvana, which in the insurance world today, it's still a lot of checks being sent around, weeks go by, a lot of phone calls, so that's what we want to change.
From the heart of the financial district in downtown Toronto, that's our show for this week. I'm Mark Bunting. In order to not miss an episode of Capital Ideas TV, please subscribe to our YouTube channel. And for more great investment ideas through our weekly digest and morning note, subscribe to capitalideasresearch.com. Thanks a lot for watching, and thanks for investing like a pro. We'll see you next time.